Why did Silvergate Bank and Silicon Valley Bank fail? Why are the bears managing to claw their way back into this market? Why are interest rates jumping all around like a kangaroo? Hang on. This is not financial nor professional advice. This video is for entertainment only. Hey everybody, welcome to my channel. I wish I came to you under more positive circumstances, but these might be positive circumstances if you're bearish on the market and want to short it, either shorting individual stocks, or my preference is to short it using inverse funds. Be sure to watch the video to the end so you can see what I've been doing that's been working and what I'm going to do in the future that I expect to work even better. The Silicon Valley Bank failing is a big deal. It's the second largest bank failure in United States history. It presently was the 16th largest bank in the United States. And it was a unique bank in many ways. It's in Silicon Valley, the heart of technology. They did a lot of lending to startups and venture capitalists. So you could say they were one of the main lenders, if not the main lender, of innovation in technology. So this is a big deal. Silicon Valley Bank had $212 billion of assets and $175 billion of deposits. It was a panic on Thursday when the few people who hadn't heard they were in trouble rushed to the bank to try to get their money out. But Thursday it was a panic. Friday, the FDIC shut the bank down. Now, depositors are only insured up to $250,000, and in some cases, people, especially with these venture startups and so forth, might have had millions of dollars in the bank, and some put their personal capital in the bank. So it's a big deal. It's a big mess. And we wonder, is this the canary in the coal mine of what could happen with banks around the country? On a smaller scale, but disturbing in another sense, was Silvergate Bank. They voluntarily liquidated because they lost so much money on crypto. They were one of the primary lenders to crypto. And Bitcoin is struggling to stay above 20,000. In this risk-off atmosphere, it doesn't look good. And the jobs number that came out is a significant thing that propelled this. The jobs numbers came out on Friday, and 311,000 jobs were added. 225,000 jobs were expected. Okay, so this is good news for the economy, but we're in a good news is bad news world. And so what happened is immediately people thought, well, the Fed is going to have to raise rates, even further to dampen the economy. But there's things about this jobs report that are sort of contradictory. The unemployment rate actually went up to 3.6, okay? And previously it was 3.4, which was very low, and 3.6 is still very low, but it's indicating that the Fed is making some progress on causing unemployment, which will lower demand, which should put pressure on them not to raise interest rates too much. But that stood in contrast to the big number of 311,000 jobs. And there's indications that the participation rate, the amount of people, the percentage of the country that actually goes to work, that increased. And so I think we got some contradictory numbers here, and I think people just decide, we're going to go with the big number, with the 311,000 jobs. That shows that more people were definitely hired, and we believe that number more than the other numbers, and it's so significantly above what was expected that we think it puts pressure on the Fed to raise rates. But on the other side of that, we got the canary in the coal mine, the Silicon Valley Bank and Silvergate Bank, liquidating, failing essentially. And I think the Fed is worried about breaking things. They want to lower demand, but they don't want to break things. And there's a number of reasons that banks are under pressure. One reason is that people are generally taking their deposits out of the bank. And the reason they're doing this is they're taking it out of their accounts and putting it into a money market or a bond or something that gets 4% or so interest, and they've been getting virtually nothing at the bank. They get like 0.2% interest or something ridiculous like that. So understandably, everybody's taking what money they can out of the bank and putting it into short-term bonds, which pay better than 10-year bonds, because we have this inversion of bonds where everything is upside down, which is also an indication of a coming recession. And the fact that banks are starting to fail is an indication that a recession is coming. The KBWB Bank Index, whose symbol is KBWB, fell 16% in 1 week. So, and this is mostly in the financial sector in general. On the S&P, which is symbolized by XLF, it fell 8% in a week. So financials aren't doing well. The banks, they're losing the deposits, are going to other areas. And they also, when the Fed raises rates, they have to pay more to the Fed for money that they loan out. And also loans are decreasing with the housing market not doing well or doing less well than it was doing. And every time the rates are increased, there's less lending activity, and that's how banks make their money. So we have a lot of things that led to Thursday and Friday's sell-off. And it was a good shorting opportunity, and I used my inverse funds, as I like to call them, to make money. I made 10% in 2 days. Jeez, I don't like to short generally. I like to be bullish on the market, and I keep trying to establish portfolios, and I'm keeping them in mind, and I'm keeping them on hand for future trading. But it isn't really possible now. You're swimming upstream against the river, and I find, it's treacherous doing these triple leverage inverse funds that I'm going to talk about. But they've been profitable for me. I can't really recommend them because they're not a long-term investment. They eventually will go to zero if you hold them long enough. But they're for short-term trading and essentially therefore a crash. I put a small amount of money into Sdow. which is a triple inverse fund on the Dow Jones Industrial Average, the 30 stocks that make up that index. And it tends to be a more conservative shorting vehicle. Although to call something triple leverage as a conservative thing is probably an exaggeration. As we look at the chart, you can see that it went up 14.5% for the week, which is good, but I'm so spoiled because I'm used to making more money with Sqqq, which always comes through for me, and it certainly did this time. Sqqq is a triple leverage inverse fund on the 100 largest companies on the NASDAQ. And so it contains Tesla and Apple and Amazon, all your FANGs, Microsoft, all the big technology companies, the mega caps. That's where technology is right now. And Apple in particular needs to come down somewhat more. Tesla has really been taking a downward move, and Meta has been struggling, although these all did well on the rebound, but now they're going down again. So I play the hills and valleys of this. I know Sqqq very well, and I seem to make a lot of money in doing this. But it did. I should have thought twice, because there was an even better alternative, and it's Srty, Srty. Srty, Srty, is a triple leverage fund on the Russell 2000. And so it contains a lot of smaller companies, most of which are technology, I believe. But it's smaller companies that are going to be affected more by interest rates. So they will probably be affected more in a recession too, as people cut back to the necessities. And if this is helpful, be sure to smash the like button. So as we look at the chart, Sqqq did well and made over 12%. But Srty, Srty, did about 10% better, as it made almost 22% for the week. So that's my plan for the next week. I think Srty, the smaller companies, they will do worse as interest rates are held high, but they will also do worse in a recession or a depression. Who knows at this point? So my plan is to do more day trading with Srty. I keep a solid proportion of my portfolio in interest-bearing money markets, which are doing well. But the interest rate has probably come down a little bit because so many people are going to short-term things that lowers the demand. Bonds always, how they move is a mystery in some sense, but in another sense, it's not a mystery. People are going to interest-bearing things, and it's a supply and demand thing. And so the interest rate has come down a little bit, but it's still pretty good. But I'm going to compensate it with Srty, which I think has been doing well and will continue to do well in this uncertain slide into a recession, which I think looks pretty certain at this point. So I'm joining the bears triple time with these triple inverse funds. I think I've given you 3 good ways, but remember, they are very short term and they are risky, so you got to watch them. And it helps to have experience with them, which I'm well experienced at this point, as I've made a lot of money on them. Thank you.